Traders, enough is enough. 2017 has been the most volatile year in FX in history. Okay, and it's been because of the fundamentals. It's about time we start addressing them. We got a new content segment, High Impact, which will the intro. Alright traders, what's going on? Welcome to High Impact. I don't have a tagline there, so first things first, I need a tagline for High Impact. If you guys can throw me a tagline in the comment section, I think that will actually be pretty cool. The best thing I got right now is news that hits. Alright, so if we can come up with something as a team, okay, throw me something that's catchy, like your profit is my motive. It took me a while to come up with that, okay, but it works. Alright, your average Joe to Trader Pro, top trader tagline, it's amazing. I need something for High Impact. If you guys can help me out, thanks, okay? So before we go deeper into the high impact fundamentals that we have coming out for the rest of this week, all right, we are going to be shooting these high impact content segments earlier in the week. We're going to be pushing back the Monday market breakdown to a Sunday market breakdown, and then we're going to get the high impact video that comes out every Monday, all right? So that's going to give you guys a chance to act on some of these moves that are going to be playing out, okay? And one thing that I do want to attack, all right, is in the Forex business, all right, in the Forex retail trading community, you have most of the retail traders. They know the fundamentals in the sense of they know to go to Forex Factory, but they have no rational idea as to what they mean, and they go no deeper than seeing if it's the actual is higher than the expected or than the forecast or blah blah blah. I mean, it's very, very surface level understanding of what the fundamental data is and how those fundamental implications are going to start driving markets. So I believe, and if you look at every single one of my Monday market breakdowns for the past 2 years, okay, I always include the fundamentals. Yes, you have a price chart, okay, you got time, and you got the purchasing price of that asset, but at the end of the day, folks, don't you understand that that is literally just an investment decision that was already made? Okay, there can be capital infused into the market over the course of, many days or many weeks. That's called sentiment. Okay, that's when the underlying sentiment of a market is just to a certain direction. The Euro USD is a great example of that. All right, but guess what? As different micro implications, okay, come to fruition in terms of CPI, in terms of inflationary numbers that come out, PPI, PMI, I mean, all the different fundamental data releases that we're going to be talking about here in High Impact. When those data releases come out, they dictate market direction, okay? And they dictate market direction because the better capitalized investment public that exists in FX, aka the smart money, they interpret that data and they use that data to forecast future market directions. All right, which is why you see so much capital being infused in the market when those data releases come about. All right, and then you see an infusion of capital coming in after the fact. The Euro USD is a great example of that. Okay, so long story short, guys, when you're merely just interpreting the technical data and leaving the fundamental data on the table, you're doing yourself an enormous disjustice. Okay, because that technical data is just that. It's a timestamp of what the fundamental players and the smart money has already done. Okay, and if you're trying to draw conclusions and draw confluences and say you have a higher probable win rate via technical confluence and not fundamental data, you're playing a losing game. Okay, putting a moving average here, having a Fibonacci there, having a candlestick there, and then having all these other different technical indications, hoping, telling you that, hey, look, markets are likely to go here. Look, tell that to the people that were trying to buy the market up, buy the Euro USD up when Trump got elected. Okay, tell the people that were looking at the USD CAD like I was last week, who wanted to buy the USD CAD because they thought the market was oversold, but then guess what? You had an interest rate hike, and then boom, we popped down another 140 points. Okay, so you have to stay in tune with what's happening fundamentally. High Impact's going to do that for you. Make sure you're liked and subbed because I'm going to try to crank out on these Monday morning. Is usually when I want to release them out. Okay, so again, if you're subbed, you'll get them really quick. And then, as always, guys, like the video for your boy. Okay, so today we're going to be focusing mostly on CPI. But to talk about CPI, to give you guys a well-rounded idea as to what it means, we're going to have to cover inflation a little bit in the two parts of inflation. Okay, so let's get into it.
That's it? Yep. Cleveland Bishop?
Yeah.
Motive FX. Yo, I love all your videos.
You subscribed?
Instantly profitable. That one's my favorite one.
Did you subscribe?
No, but we gotta hang out and trade sometime.
No. Subscribe.
Cool. All right, guys. So first, before we attack CPI, and again, we're going over CPI because the USD, US dollar, they have a CPI release that comes out tomorrow at 8:30. We just had a CPI that came out for the GBP on Tuesday, it was at 4:30 in the morning, they were looking at 2.5 year-over-year growth in consumer prices, and it got 2.9%, which is why you saw a resurgence of capital come back in on the GBP, especially on that GBP JPY. Okay, you had an economic divergence happening on that GBP JPY. You had weakness coming in on the JPY, and strength coming in on the GBP, giving you a parabolic move that we haven't seen. Okay, I think it was one of the largest single point moves on the GBP JPY in 2017. Okay, so again, you want to stay in tune with what's happening, because it can definitely give you an amazing situation to be in if you're in the right direction on those moves. Okay, so other than that, we're looking for a 0.3% year-over-year increase in our CPI. Okay, here in America, right? We have missed target on CPI 7 times out of the past, 7 months that we've actually calculated the data in 2017. Okay, we have the August release coming out in September tomorrow. All right, so then we'll have 8 data points to kind of track and see how CPI is doing. Here's the interesting thing about CPI. All right, CPI dictates on a large scale what these monetary policy makers and what the Fed are doing to kind of give us an idea as to what they want to do for our interest rates. All right, I can show you guys a million different articles where they were talking about the Fed and the CPI and how the CPI has heavy implications on their decision making in terms of increasing interest rates, which is what everybody in the retail market knows is one of the major drivers to a currency move. All right, so guys, right now, again, when it comes to CPI, you have to understand CPI in terms of inflation. Usually, when people mention CPI, they're directly attributing consumer prices to inflation. Okay, so we're going to represent inflation as I and F. All right, and if you guys don't know the definition of inflation, inflation is when you're increasing the money supply to the extent that 1 unit of currency is worth less. Okay, but the part about inflation that people don't understand is that you can be increasing the money supply. Okay, you can be printing capital, but if no one is spending the money in the economy, then guess what's going to happen, folks? You're not going to have an increase in inflation, and that's what's happening in a couple of the central banks, in a couple of the economies that are part of the reserve banks. So Canada, Australia, the JPY, the GBP, and the Euro. You have economies that are printing capital, and again, they're having a hard time hitting off on inflationary targets because no one is spending the money in the economy. Okay, the Euro is a great example of that, where they're doing $60 billion in asset purchases on a month-to-month basis. We can talk about that a little bit later, but again, that's a scenario where they're not seeing an uptick in inflation. All right, so that's one type of inflation where you are literally printing capital in hopes that people are using the money in the money supply. Okay, it's important to have monetary volatility where there's a circulation happening and spending happening in the economy. Okay, and a loose monetary policy is just that, where the money is very attainable, and you're hoping that since money is so attainable that people are going to spend it. The other type of inflation is called cost push inflation. It doesn't incline printing capital, but it does incline hoping that an increase in prices in the economy gets the consumers in that economy to start spending more of that capital. Okay, so that's why CPI is so important. And that's why CPI is really one of the number 1, if not number 2 metric that the Fed is looking for right now on a month-by-month basis. Okay, I showed you guys a graph of CPI earlier. Here it is again. We've been at a high of 244 in 2017, okay, fluctuating between 244. I don't think we've gone as high as maybe 244.50. But at the end of the day, as you guys can see, we've been averaging down month after month. And we've been hitting off in the 243s more often than not, okay? So the August release is very important because I personally think if we hit off in the 243s again, we're going to see an enormous escape of capital in that US dollar, okay? So now we have to rationalize and see why CPI is so important. I don't think we touched on it. So we've already mentioned that there are 2 types of inflation, okay? You got demand push inflation. You can call it DPI, okay? And again, that's increasing capital via quantitative easing. If you guys hear that word a lot, that's what they're doing there. And then you also have cost push inflation. all right, which is CPI. Okay, so CPI represents cost push inflation, but it also is an acronym for the Consumer Price Index. There are two different things, but they are they're very well correlated because, again, when you have cost push inflation, you're looking for CPI because CPI is cost push inflation, all right? So cost push inflation is when you see an increase in the money supply based off of the amount of spending happening within said money supply. Okay, so you have all these different consumer goods. Imagine all of this here as different consumer goods, and all these consumer goods are priced at a certain price point. Okay, so let's say all these consumer goods, your livelihood, let's say transportation, let's say entertainment, let's say education, let's say all of that is priced at $100. So the average American spends $100 a month based off of all of these things that they spend on a month-to-month basis. Okay, well, what the Fed is looking for is they're looking for an increase in prices across the board, okay, in a nice fluid overall transition to where prices increase and people are having to pay more money, and now it costs $102 to live your life. Okay, so again, this is cost push inflation. There's two more extra dollars coming from that one citizen fluctuating inside the economy. Okay, and that's a good thing in terms of you trying to forecast or you trying to put the economy in a situation where it's strengthening. All right, now here's the thing about cost push inflation that's happening right now. We've already gone through our demand push inflation in the United States. Right now we're here, and as you guys can see on a month-by-month basis, we have not edged higher at all. Okay, we have been stuck month by month at just this number here, where over and over again we're not getting an increase in the CPI. So this will be a representation more of the United States, okay? But if you look at the GBP had a CPI release that came out on Tuesday, all right? Which is why I'm excited to start releasing these on Monday so you guys can you guys can play these throughout the week. GBP had a 2.9% increase year over year in their consumer price index. All right, so GBP is actually performing pretty well, which is why you saw, again, that ridiculous move in that GBP JPY. We are not able to do the same thing. Okay, this has been a metric that the Fed has been trying to rationalize for the past 2 quarters. All right, we did a rate hike in March. We also did a rate hike in June. All right, both of those months we had CPI at pretty much leveling off. In March, you can kind of understand why Janet Yellen, proclamated a rate hike and actually executed on it because you only had January, February data that came out. But then when we had June, you had January, February, March, April data that came out. And again, you had CPI really go nowhere for those 5 months. So that's why the June rate hike is one that people are questioning. Now we have a December rate hike in the question. Okay, and right now the market is sitting at a 37% likelihood that we're going to heighten rates. Literally, it's decreased by, I think, 20% in the past 3 weeks. And that's because you got people outside of the Fed and the Fed itself split between an interest rate hike or not, okay? And they're split because of the consumer price index. You got Donald Trump himself wanting a weaker dollar because of the America First ideal. But then you have individuals in the Fed like Janet Yellen, for example, who have been advocating a rate hike. But again, the synergy just isn't there inside of the Fed organization and they haven't been able to execute on it, all right? So one thing that I haven't mentioned is the 2 types of CPI, and then we're going to wrap things up. Okay, because this is very important if you guys want to go and do a little bit of extra research on your own. All right, so you have core CPI and then you just have CPI. CPI is everything, okay? CPI is everything inside of the economy: education, energy, food prices, entertainment, all the things that exist in all the expenditures that you would have in your day-to-day life. Core CPI is everything excluding energy, okay, and food prices, okay? So again, commodities, folks, okay, you got food, basically you have wheat, you have pig skins. Again, pig skins are trading on the Chicago Mercantile Exchange. You have a lot of different things inside of the food category that are extremely volatile on a month-by-month basis. And then obviously energy, you can see oil, again, very, very volatile. And if you throw these metrics here into the consumer price index, you could have an uptick in the consumer price index based off of the volatility of these two. And then you can start enacting monetary policy because you see that the market has, pushed higher, when in actuality, it's just the volatility of the commodities market itself. Okay, so you want to exclude energy and food prices. So you might want to check out the CPI, the core CPI, instead of just looking at the arbitrary CPI, which is everything. All right, so guys, look, you got to stay in tune with what's happening with these fundamentals. I'm going to be cranking out on these once a week, and I want to headline some of the more important fundamentals fundamental data. This is, video 1, so these are going to get a lot better. If you guys give me some questions and give me some topics that you want me to talk about, boom, we can start elaborating on this stuff, and you can start making better trading decisions because the high impact stuff that's coming out in this market on a day-by-day, week-by-week basis. Okay, so guys, your profit, always my motive. If you guys need anything, let me know. Get inside that Top Trader community. Make sure you subscribe so you get this stuff quick, and like the video for your boy. I'll talk to you guys real soon. Peace.